Well, good afternoon, everybody. I'm going to present some contrast of what's going on in Europe and in what's going on in Asia Pacific. Try and give you some ideas about the relationship that the financial sector could play in revitalizing the economy. So what I want to do is to look at four issues. The first is simply where the financial sector can change from being the source of the problem, which it is in the current global financial crisis, to being part of the solution, which is what it's always intended to be. The financial sector is expected to be able to reduce the impact of shocks on the real economy. The second thing which I want to look at is the way in which the structure of the sector is changing and the way in which its regulation is changing in response to the global financial crisis so that it can play a better role in the recovery of the global economy. Then thirdly, I want to look at how monetary policy and fiscal policy can be changed back to normal. I must admit, coming here to Japan to talk about that where you're well embarked on doing the exact opposite may seem a little bit premature. And lastly, I want to talk about problems as imbalance. That one of the great difficulties we have is the imbalances around the world. And the main issue here is asymmetry. The people who are doing well don't have to adjust. They can choose to, but they don't have to do it. The people who are doing badly have to adjust, and the process of adjustment is extremely painful, and hence you have a real difficulty in moving away from where you are at present. So let me go to the first of these then, and talk about the move from being the source of the problem to being at least part of the solution. What you're hoping out of the financial sector is that it helps absorb shocks so that it manages to redistribute the shock over parts of the economy which can bear it. So let me give you a very simple example that there are large losses as a result of the global financial crisis. If those losses fall on rich people, then the impact on what they do is relatively limited. If they fall on ordinary taxpayers and people on low incomes, then those people have to change their behavior. They don't have other assets to fall back on. They have to consume less. They have to have a lower standard of living for quite some period of time. So if you don't redistribute to the people who can manage to absorb the loss, then the loss has a much bigger real effect across society. And what normally happens, of course, is that the financial sector spreads it. And that's precisely what bailing out does. The bailing out spreads the cost over a very large number of people. So it spreads it so it's very thin. If you look at what happens with real shocks, of course, one of the big problems is that a number of people become unemployed. So if GDP goes down by 5%, most people are not much worse off. But a small part of the population is a great deal worse off. So that makes the real shock much harder. The second side of this is that we can actually alter the nature of the behavior of the sector. And regulation indeed helped make this work before the financial crisis by making the financial sector pro-cyclical. In other words, it made cycles bigger. And part of that was just the regulatory system. That's because people, when they were holding capital against possible losses in the future, as the economy does very well, so the possibility of losses seems smaller, so ratings rise. And you need to hold less capital if ratings are high. When you get to a downturn, then the ratings fall. You need to hold more capital against the same risks. So at the time when it's very cheap to raise capital, you don't do it because you don't need to. When it's extremely expensive to raise capital in the downturn, then you have to do it. And that was largely the caused by the regulatory system, but partly by some other aspects. But there's one problem which we can't solve very easily, and that's simply why we get into booms and busts in the first place. And I think that the sort of Minsky view about this is probably one of the best to look at, which is that we slowly become more and more optimistic as time goes on, and because that success seems to work, we think we're going to be able to do even better than that. And so you can slowly get this building up and building up. Confidence becomes higher and higher. But at some point you find that this has gone far beyond what is actually sustainable in the long term. And then you have a very sharp downturn. So you don't get a smooth decline, you have a slow build-up and a very sharp downturn. And one of the reasons that you can get this is it's always possible to find a rationalization of why things are all right on this particular occasion. And there's a very nice book written by Carmen Reinhardt and Ken Rogoff called This Time is Different, and it's looking at 8 centuries of financial folly. If we think about the rise to the dot-com boom, the reason everything was going to be different was because information technology was going to change the way in which companies worked permanently. They'd always be able to grow faster, and hence if you could get just perhaps 1% extra in the rate of growth indefinitely, this has a huge impact on the prices of firms in the stock market in the short run, because all of those prices are forward-looking. So they take all of those future revenues and they put them in the present. So a doubling of the price of the stock market price of a company, perfectly reasonable under those circumstances. Just doesn't happen to be true. What about my second point, changing the structure and regulation of the system? The first set of changes which are occurring are ones which suggest that we should try and isolate the parts of the financial system which cause the problems. So the areas where there's a lot of trading activity going on, we should try and separate that from the things which are actually essential for the operation of the economy. So ordinary retail banking, finance for firms, and particularly small and medium-sized enterprises. And the UK has produced a report suggesting how that should be done by Sir John Vickers. The Euro area has produced one with a group headed by my former colleague Erkki Liikanen, and the US, the former chairman of the Federal Reserve, Paul Volcker, has suggested it. They're not all the same, but it's the same principle, that we divide off the troublesome areas from the areas which are essential. The second one is that we spent our time this time round with the taxpayer bailing out failed institutions, because the alternative was too horrible to contemplate. If the very large American banks had gone bust, it would have had even more serious effects on all of the rest of us. And the same was true in Europe, and the same has been true in other countries. The problem is that you need to change this circumstance and make it possible to resolve any bank so that the private sector pays rather than the public sector paying, and rather than the taxpayer paying. And those changes are taking place. The Recovery and Resolution Directive is going through in the Euro area at present, in the EU at present. The third item there is you need bigger buffers, so that when things go wrong you can absorb the shocks. And that's what's happening with Basel III, which is increasing the amount of capital and indeed liquidity which you need to have. You want to think about the difference between how buffers work with a train, so that when the train travels too fast or goes too far into a station, it hits the buffers and it absorbs the shock, but the train is still in one piece, as are the people inside it. And you want to compare that with crumple zones in cars. When you have a car accident, you can probably walk away from the car, but the car is a complete write-off. The problem with the previous system, with what they thought was capital, was that it was far more like crumple zones, and in fact you've ruined the bank, even though it's managed to absorb the shock to some extent. The fourth thing is that we've now realized that there are all sorts of parts of the financial system which can cause problems, and hence regulation needs to be extended to them. In my own country, the finance company sector, deposit-taking finance company sector, has virtually disappeared. That was actually a homegrown problem, but one which nevertheless shows the problems of not having enough regulation. The other side of that is that the sum of the parts are not equal to the total. It was thought previously if only you supervised every individual institution properly, then you'd be supervising the financial system as a whole properly. We've now realized with contagion and other difficulties there are far more things which are going on where we need to look at the economy as a whole. And this whole area of macroprudential regulation has now arisen. So that's one particular lesson which has been clearly learnt. And the last one which I wanted to deal with is trying to solve the problem of banks running across borders. Because the difficulty with those is that they're internationally owned, But if you have a problem, that problem has to be solved in each individual jurisdiction. And it's extremely difficult to put that sort of game together because people find it very difficult to work together. What has happened is that New Zealand has chosen one way and Europe is choosing the other. What the New Zealanders have said is their main banks are all Australian owned. Are the Australians going to look after us if something goes wrong? The expression in New Zealand is, yeah, right. In other words, they're not going to. That you can't guarantee that that's what's going to happen. And therefore, New Zealand has decided it has to be able to resolve its own problems. And that's the way in which it's structured the process of banking resolution. So it doesn't matter what the Australians decide to do, New Zealand will be able to look after its own financial stability. Europe, on the other hand, this would run right against all of the principles of the European Union if you were to go that sort of way and divide all of the countries up. They've got to find some means of operating together, and that's a great deal harder. But they've gone quite a long way towards doing that. The first thing they've decided is, well, you ought to have a single method of supervising all of these banks. So the ECB is now going to run that, and all of the large banks will be dealt with as a whole, even though they're running right across all of the countries. The second side is that they're introducing and indeed have already agreed to introduce much higher capital standards, so that there has to be a much bigger buffer. And this is being introduced by the Capital Adequacy Directive 4. Or you'll notice that the Europeans go in the exactly opposite way to the Americans. Any of the American acts have really long names. The reason it's called the Dodd-Frank Act is because nobody can remember about it, something to do with the Wall Street Improvement and Something Else Act. In the European case, they just go for an acronym, and therefore, so this is CAD4, and nobody can remember what the bits of that stand for either. The remaining one is the Recovery and Resolution Directive, and that's trying to get rid of the problem of too big to fail and to make all banks resolvable, even though they run across borders. The only drawback is that the one part of that which is not in place in the current proposals for the directive is actually the cross-border bit, that most of the other bits they've seemed to have got sorted out. Getting monetary policy and fiscal policy back to normal. That was the third of my areas. The first thing is obviously trying to get out of quantitative easing. Now, the Americans have certainly been talking about it, and even just talking about it has resulted in shocks to interest rates and stock prices around the world, and indeed exchange rates. It is not going to be easy to get out of this. The way in which policy has been run in the US, and indeed in a much more extreme way in the global financial crisis, is that you're not quite sure when things are going up that there is a bubble, and that therefore policy is reasonably tolerant on the way up. When the bubble collapses, you know everything's wrong, and the thing to do is to throw as much at it as you can to try and avert a serious downturn. Of course, this time round, not only have interest rates gone down to zero, that wasn't enough. Quantitative easing has followed to try and drive interest rates further out along the yield curve down to zero, and also to help liquidity. That is a huge distortion. Unwinding it is going to be really difficult to do without causing all sorts of problems. If we look at the fiscal side, then the problem is to have a structural balance which will last over the future. So we know that you're going to get big deficits when the economy turns down. What you're hoping is that you've got something which is symmetric, so that when things improve, then you go back to running surpluses. A large proportion of countries around the world, because we've been having a nice enthusiastic period, had cut tax rates further than made sense for the long run. They've therefore had to do two things at once. They've got the big deficits because they've got problems, but they've also had to try and reorganize their systems so that it makes sense over the longer term, and that's painful. And that's really what's caused the problems in some of the Mezzogiorno countries, as was just described earlier. And because of the twin problems, they've now got a great deal of debt. And the problem for this means is if something else goes wrong, any country which is very heavily indebted hasn't got the choice of running the normal mechanisms again, unless it wants to actually default. It's got no room left for maneuver. So, but my own country, our debt ratios are still pretty low, even though we've had some difficulties, and we're already back to structural balance. It's purely that our growth rate isn't quite up to high levels so that we have a surplus. But we're clearly on the way to doing that. And then the last issue of imbalance. And mainly this is coming out through exchange rates. But we can see that there have been all sorts of advantages of having fixed exchange rates. So if we look at what happened to the southern European countries, when they joined the euro area, interest rates were really a lot lower than they were before. We saw that the convergence in those slides occurred beforehand, but that was because purely everybody was expecting that they'd join, and therefore the convergence accrued earlier. This resulted in much faster rates of growth, also resulted in much faster rates of inflation, which is, of course, not what they were intending. So you can see that there are all sorts of advantages, including a reduction in transaction costs. The disadvantage is when something goes wrong. Then you can't adjust relative to either the other members of the area, or indeed with respect to anybody else, because you can't move the overall exchange rate for the euro area compared to other countries. You have to take whatever makes sense for the euro area as a whole, and if you're in the minority, then what makes sense to you doesn't make sense to the rest of them. And this is a very important area of asymmetry. It is extremely difficult to become more competitive if you can't change the exchange rate. I mean, this is the old problem which Keynes addressed in the 1930s. Trying to reduce nominal wages and even real wages is extraordinarily hard. I mean, all of you would enjoy really having, taking a 25% wage cut straight away. I mean, we'd all think that that was perfectly reasonable. It would make Japan competitive immediately, and you'd all sign up for it. The way in which it's occurring with Abe economics, as we saw in the first paper, is, of course, that the exchange rate has gone down. And this has been able to do it quite painlessly for people. Their nominal wages have gone down compared to their competitor countries. There are no protests in the streets as a result of doing this. If you try and reduce them by 25% in one go, you'll most certainly get complaints in the street. And the last one in that is foreign exchange reserves. But again, this is just a sign of imbalance. When this gets unwound, it's a sign of it will be also fairly difficult to do. Let me give you a couple of examples, one in one direction and one in the other. This first graph is looking at New Zealand. New Zealand does have a flexible exchange rate, but it's a really flexible exchange rate. If you look at the fluctuations on that graph, they're of the order of 30% up, 30% down, and then up again. That really gives you a problem if you're trying to run a competitive company. There is a limit to how much flexibility really makes sense. So it's not surprising if around Asia Pacific, one of the main issues is, can we actually reduce some of those pressures to some extent? If we look at what's happened to foreign exchange reserves, other emerging markets other than Asia and Latin America, when we got to the global financial crisis, the reserves haven't increased. But here and in Latin America, they have. But you want to watch out what this means, because those foreign exchange reserves are showing what's happening in the public sector, what's happening in the central bank. If we look at this example from Latin America, you can see that the private sector is not only in deficit, but it's been getting worse. So the public position is covering up a private imbalance. So let me draw to a conclusion. The issue which we have at present in Australia and New Zealand is we have a really strong banking system. Our banks didn't get into trouble during the global financial crisis, and they don't look as if they're getting into trouble now. But if we look at Europe, then many of the problems are actually still hidden. Many of the banks do have difficulties. Whether the new round of stress tests, which the ECB is going to put in place next year and the year after, are going to sort that out, I'm not quite sure, but certainly it's moving in the right direction. Moving to banking union is going to be really good for sorting out the long term. That will mean that there is a single way of handling the problems. It doesn't sort out the current problems, or legacy problems as they're known. That's got to be sorted out first, and it's still got, therefore, the link between sovereign debt and weak banks, and that's still to be addressed. Both Australia and New Zealand have got really good absorptive capacity because they have low debt ratios. So if something else goes wrong in the world, in our recovery from the global financial crisis, we have a second crisis, they've got the fiscal capacity to do it. That's very clearly not true for quite a lot of European countries. My view is that the chance of a smooth recovery is pretty small. Everybody wants to see smooth landings every time you get out into difficulty or out of it. If we look at history, we see you just don't get that. Maybe it'll work. I certainly hope it will, and I'm sure all of you do. Whether it will is a different issue. But we have one thing which is altering this game. Japan is trying a different technique, and it's doing this by a process of extremely rapid and extreme expansion. We can't all play this game at the same time, but if it works for the Japanese, maybe we can play it in sequence. Thank you.